Welcome to the Strategy of the Week for May the 24th, 2013. My name is Cathy O'Nan. I'm an instructor here with VectorVest, and I will be bringing you tonight's presentation entitled Staying Long for the Long Run. We had a subscriber call that was very happy with the results from our Surefire Success trading plan. His situation was different. He was unable to short stocks, and he was also uncomfortable trading those Contra ETFs, which when leveraged can have high volatility. Well, I went to work to help this subscriber and did some research and some back tests using a third alternative, which was staying long. Now, this methodology is called bear market beaters, which uses the approach of buying stocks long even in bear markets, because we know not all stocks go down. Now, this is the basis of tonight's presentation using a search called Marathon from our bear market beaters group located in Unisearch. So let's move over into the program. Here we start on the home page of VectorVest 7, and we'll move over to our Unisearch tab. In Unisearch to the left, you'll see a directory of our search group folders, and I'm going to choose Bear Market Beaters. And as we open this, you'll notice we have several searches that are to be used. As we say in the comment box below, these strategies focus on making money in long positions even during bear markets. Now, it also refers to an essay that was written by our founder, Dr. DeLito, that is in the Views from February the 21st, 2003, and I'll take us there. Here we are at the Views, and as Dr. DeLito says in his essay, buying long in a bear market is like climbing a mountain in the face of an avalanche, but a lot of people have to do it. You have money managers, mutual fund managers, brokers, and so forth who need to stay long because of investment charters or company policy. I know I get a lot of calls from subscribers who, because of their IRA constraints, need to trade long. It's at this point that Dr. DeLito introduced a competition for our subscribers, creating strategies that beat the bear market, and we received some really great entries. Now, one of these was an entry called Marathon, which I'll be using tonight, and it was submitted by the Groves. In my back test, this search crossed the finish line as the winner compared to the other searches in our bear market beater group for the test period that I'll be using starting January the 4th, 2010 up until current. Marathon simply buys rising stocks in rising industry groups and sorts the stocks by our value, safety, and timing VST vector score. The question I wanted answered was, can I perform as well or better than the Surefire Success portfolios? So this was used as my baseline run, and I was extremely pleased with the results. So let's take a look at the chart of how those performed. Looking at the Surefire Success results from January the 4th, 2010 to May 24th here on our chart, you see the listing of our 4 model portfolios, and the leader was using the S&P 500 stop ascending for the long and Doug Downer's supercharge for the shorting strategy using that RTC combo pairs and using the green light buyer RT kicker combo as the timing signal. We see that the top winner was at 51.14% annualized rate of return with a drawdown of 19.33 and ended at a value of $272,908, which is great results. The other 3 portfolios performed well also. We did have drawdowns at around 30% in the other 3 portfolios, but if you remember correctly, starting in January 2010 took us through that extremely difficult time in 2011, which was a very tough time to trade. In fact, our VectorVest composite dropped in 2011 23% in just a short 5-month period. So again, this did manage us through that difficult trading time. Here we have the results where I used the S&P 500 stop ascending and used Marathon from the Bear Market Beaters group, buying long during a down market. Now, I tested this several ways using different stops. I looked at hedging versus not hedging. I looked at using the green light buyer RT kicker and also the combo timing system. My best results came from actually flipping the portfolio on the confirmed down signal using the green light buyer RT kicker signal. Hedging did not perform as well. Looking at our performance of the S&P 500 stop ascending with the marathon, we see we had an annualized rate of return of 66.02 with a drawdown of 31.77. The other portfolios, the three listed there at the bottom, they also had around a 30% drawdown. But again, that did take us through that very difficult period in 2011. Let me take you over to the backtester and I'll show you the equity curve. Here we see where our max drawdown was again during that period in 2011, especially during the summer where we did have our max drawdown. Here we are ending the year at right around 51%, and we see that nice equity curve since that period of time. Now when running backtests, we often get the question, how would this have done had we started back in 2007, which would have taken us through that extreme bear market? Let me show you the results. And you can see we were underwater late 2007 and didn't recover until March 2009, and that's why this is not a surefire success trading plan. How would we have known to have moved to the sidelines if we were trying to trade in a bear market? Well, if you had looked at the views on February the 15th, 2008, our market climate graph showed that the VectorVest S&P earnings indicator had fallen below the level of 1, and it had been falling over a 4-week period from 1.05 down to 0.99. This would have been a good indication to move to the sidelines and to let you know the bear had gained some strength. Now, if you had used this signal to exit and waited to come back in, you would have waited until early 2010, which is when I'm using as my test bed. For those of you who wanted to take advantage of that market rally starting in March of 2009, you would have read our views on March the 6th, 2009, where Dr. DeLito wrote an essay called Itchin' to Rally, and you would have seen those signals if you had wanted to get in sooner. Now let me walk you through the settings and let me show you the changes that we made using the S&P 500 stop ascending and buying long for marathon. To create a new backtest, we'll go up and hit New, and we start with our account settings of $100,000 with $9.95 per trade, not using margin. This tab allows us to use market timing. This is available if you have the auto tester. If you do not have the auto tester, call our office for a free 2-week trial. We'll be glad to add it to your subscription. So we're going to use the green light buyer RT kicker. I tested several of these timing systems, and again, this one worked the best. On the automation rules up, we're going to be using that search, the S&P 500 stop ascending, which is located in the searches RT combo pairs, and it's the S&P 500 stop ascending. Our stop criteria will be a gain loss of 50-10. And we will use intraday stops, and now we'll move to more settings. We will change this to 5. We will automatically replace closed position and try to open all 5 immediately. We will not close any position when entering this situation. We'll invest average portfolio value, odd lots, and we will limit the repurchases not to buy a stock that we already own. We will change our maximum percentage of a stock's average volume down to 2%. Next, we'll move to the automation rules down. This is where you need to change on the down signal. Instead of selling short, we are continuing to buy long, and we'll be buying from the searches bear market beaters using marathon as our search. Out of the stop criteria that I tested, I mentioned that the 2010 had the best results, so we'll change here. Intraday stops will stay in place. More settings, again, we'll change this down to 5. automatically replace closed positions, and we will try to open all 5 immediately. We will leave this setting to close any open position when entering this situation. Using this timing signal, the signal for down is entering a confirmed call, so we would close any positions that we were holding and search from the marathon folder. We'll invest our average portfolio value, odd lots, also limit our repurchases, and change our maximum volume down to 2. On the automation rolls neutral, we'll take no action. We'll let our stops stay in place, and next we'll move to our test period. We've already seen the results going back from the 1st of 2010, so let's change this one and we'll start at the same date as our model portfolios, which started in January of 2012. Next, we'll give this a name, and we'll hit Finish and Run. Here's the graph for the equity curve starting again in January of 2012 up until current. And you can see our annualized rate of return of 76.51 with a max drawdown of only 9.82 and our commissions at 766 being very reasonable because we're looking at almost a 17-month period. So that's only about 5 trades per month. So again, this is not an active trading account, very manageable. Now that you have this back test in place, if you would like to alter the dates, you can go up and copy, or you could edit and rerun the test. This brings us to the end of our presentation. I hope this strategy gives you another tool for your trading, especially for those of you who are restricted in your accounts. As a reminder, the markets and VectorVest will be closed on Monday to celebrate Memorial Day. I hope you have a great weekend, and thanks for joining us.